All right, so we're beginning module 2. This will be chapters 3 and 4 as we go through it. If you notice here, I put problems 1, 2, and 3 on the same slide. They're a bit related. I just wanted to talk about it a bit. So when you buy government debt in the United States, each level of government is not able to tax at the other levels of government. So states do not tax treasuries. The federal government cannot tax state bonds. And so because of that, treasuries just have a different tax profile. And so when people are making their decisions on purchasing those, that's what they're focused on. When it comes to things like the muni bonds, because they're going to be exempt from state and federal taxes, and often they're going to be local taxes as well, then they would be triple bonded or triple tax exempt bonds. And then that would make them the most attractive to people that are paying the most in taxes. And so that's why muni bonds in particular tend to be held by high net worth individuals. They're doing it to minimize their taxes. And then if you notice there at the bottom, there's these are unusual types of bonds. So a warrant, a convertible, and a puttable bond. Those have a built-in option, and near the end of the course, we'll talk more about options. But it's a chance for you to either buy or to swap it out for stock or to make them buy it back from you. The income bond looks a lot more like a special dividend almost, but you can have it set for some sort of profit sharing, so it looks more like stock than a bond. And then cap bonds are a special case where it's really a risk financing tool using a lot of the bond structure and how you have that. Okay, and so here's a way of calculating one of these bonds. So you have a 21-year treasury. The face value is $1,000. We have a coupon, but they tell you, okay, this is what it is as a 6-month bond because it's pays every 6 months. The reported yield to maturity, and again, they go ahead and make that 6-month for you. So what's the present value of the bond? If the yield to maturity changes to 1, if it changes to 8, and if it changes to 15. So if yield to maturity drops, the bond price goes up, right? Because interest rates and bond prices move opposite each other, right? And so you notice when the yield goes up, the bond price falls down. And you see there the equation, and then you can just change the yield to maturity. When you're doing it on the calculator, it's you have to just change it to every 6 months, and then you have the 42 periods for the 21 years, and your IY would be 1, 8, or 15. All right. Here's a yield to maturity change, and so how does that affect what happens with our bond price? So bonds yield to maturity doesn't change. The return is equal to the yield to maturity, but if you assume the yield to maturity is 3.8 and you assume it is 5.8 and calculate what the bond price is and then what it will be, your rate of return, as you see, ends up being the same as your yield to maturity. And it'll do that because you're holding it over that period. There's the math. If you do it on the calculator, I'm pretty sure on the we're talking about time value money, I show the yield to maturity is what I'll put in as my my IY, and then I have my cash flows. All right, and yeah, here's the same type of thing. I've got this exact example on that other slide when I show how to use Excel. for the yield to maturity and the duration. But the thing I wanted to talk about is the duration, right? And you notice that's given in years. And the way to think about this duration is, at what point have I sort of balanced my payments, right? So like, if I were to put these on a stick, where would I have to balance this timeline for it to be perfectly balanced? And that's what we calculate with that duration. This is important because we're going to have duration of debt, right? Like these bonds and things like that. But we also have duration of assets, how long a piece of machinery will last until it needs to be replaced. And so by balancing that, I don't end up where I'm paying things off really quickly. And so I'm not able to take advantage of the financing, or I'm paying it off too late and I'm holding a lot of debt for items that, I don't even really need this machine, but I'm still having to pay for this debt, and so you just want to make sure those match up. Here's the same type of calculation we were doing before. We're just doing this one in euro instead of dollars, but as you notice in the equation, it works the exact same way. We can price our future cash flows regardless of the currency. And if you notice here again, we're going to be calculating duration, right? And the duration again lets us know about where we've balanced this one. So if you notice, security A, security B, security C, they have different cash flows in period 1, period 2, and period 3. And so you can see how weighted they are, whether they're getting it sooner or more money later. And so you see that duration is different, right? And what that duration is the average weight, right, of the present value of the cash flows. So if you go to security A, you take the cash flows, calculate the present value of those cash flows, and then you would calculate how much weight there is given that. So the volatility, as you see below, so you would take the duration and divide that by 1 plus that interest rate, right? And that volatility lets you know how much or how sensitive you're going to be. There's another measure of volatility that also involves duration, Macaulay duration, that we're going to get into a bit later. But this duration, you can think of it as, how long should I expect this debt to last? Is kind of a way of thinking of it. And it may be weird to think of it that way because you think, we're going to, it'll be 3 years, right? Because that's what it lasts. But, if this were a loan, you're going to have people that refinance and things like that. So you really need to think about where the weight of the money is within that, right? Am I getting most of my money up front? Do I have to wait a long time to get it? And that's what the duration's telling you. The difference between nominal and real is the concept of inflation, right? I know we've had inflation very long for a long time, very low for a long time. And so it wasn't as much of a concern, but as we're seeing inflation creep up more and more, then we need to account for that. So the nominal return, anytime you see nominal, that's the named or the stated return. And then real means without or accounting for inflation. We've pulled the inflation piece out, and the real is what I have after accounting for inflation. And if you notice there on B, it said, now suppose the bond is TIPS, right? TIPS is Treasury Inflation Protected Security. So it's a special type of treasury that gives you real to make up for or to protect you from inflation. All right. Chapter 3, problem number 10, right? So we have the spot interest rate, which is the rate I would get today, is 7%, and the 2-year rate is 8%. So if I lock in for 2 years, I get 8%. So the question is, well, what must we think it's going to be 1 year from now to last that other year? Because I know that my 7% plus whatever I get the second year has to equal getting the same thing as 8% for 2 years. Right. And so what you do is you'd say, okay, I'd get 8% for 2 years, and then I'm going to get 7% for 1 year. So I'll, take the 2-year rate divided by that 1-year rate. And then, what I would end up with is this 1.09. That's why they subtract the 1 off here. And if you make that a percentage, 9.01. It's not 9 because 107 times 109 is not equal to 108 times 108. It's a little bit different, but yeah, that's the what we're doing with that one. And this right here is how we calculate what we call our future rate. So we do what's called bootstrapping, where we fill in what the rates are for the ones that don't actually exist, because there's not a 1-year rate that exists, or a 1-year rate 1 year from now. Like we don't know what it's going to be. We'll see what it's going to be in a year, but the market is behaving as if it's going to be 9.01% because that's the pricing that would work. Okay, so this is the calculation. What they're doing is they're giving us a 2-year rate, and they're telling us what inflation is, and then we have to calculate, well, what would the real rate be? So I have to take off the inflation, right? So I would take 1 plus the R divided by 1 plus my I, the inflation. Subtract 1 from that, and that would give me the expected rate. Okay, and then within chapter 4, the first one, they're giving us what's called the order book, right? And bid and ask is, are people trying to buy or sell? And they will tell you how much they want to buy or sell at each price. So if you see our price is right now is going to be somewhere between 104.4 and 104.9, right? Because those are the biggest bid and the smallest ask. So we're going to be somewhere between those two. And let's see. The first one, Georgina submits a market order to sell 100 shares. So if she's going to sell 100, then it's that bid price. Somebody's put out a bid and they said, I will pay 104.4 for 100 shares. That's what that size is. That's how much they're willing to accept at that price. Right now, if you submit a limit, or no, so the second one submits a market order to buy 400, what's the max that he will pay? So he's buying it, so it'd be the ask, and it's 400 shares. So the first 200 would be at 104.9. The next 200 is 105.2. So the most he would pay is 105.2, right? And if he ordered a limit order at 106.4, like if he said, hey, I would be willing to go as high as 106.4, would it execute immediately? Yes, it would. If he had his limit set at 105, it would not, right? Because I would need to go as high as 105.2 to be able to execute that immediately. And a limit order is how that book gets made, because those limit orders float out there. All right. Non-constant growth, right, means what is going is it's growing really quickly. These like exponential type of growth curves, right? You can't do that forever, right? Constant growth, the highest you can do is what we call your sustainable growth rate, right? But there's just limits to how much capital you can receive or have access to. So there is going to be some sort of limit to your growth, but in the short term, you can grow extremely quickly. And we see this with startups all the time. And that's why they call that super normal growth, right? But you cannot sustain that. Here's a company, they do not pay dividends. So that means all of the money they receive, they can invest back into the company. In 5 years, they will start paying dividends. And then at that point, the dividend will be 50 cents per share. You say the dividend is going to grow at 8% per year indefinitely at that time. And then we're saying the discount rate is 15%. So what they're going to do is say, okay, well, it starts paying in year 5. So I need to calculate the price in year 4. And so what would 50 cents discounted back at R minus G? Remember, R is my discount rate, that's 15%. G is my growth rate. The dividends grow at 8%, right? And so that would tell me what it was worth then. And then I would discount that to today. And that ends up being $4.08. Okay, here's a company. The dividend is going to grow years 1, 2, and 3. And then it has a constant growth rate at 5%. We have a required return at 10. So, R minus G would be the 10% minus 5%. You can calculate what the dividend is at that point, and then you have a string of dividends leading up to it, and you would calculate that back into present day. And that's how you get the 2130. Company Y does not plow back any earnings and is expected to produce a level dividend stream of $5.30 a share. If the current stock price is $4.30, what is the market capitalization rate, right? And so basically we're going backwards and we're saying, okay, if I know the price and I know the dividend, what's R, right? Because, we've been saying dividend divided by R, or say R minus G, but this one, they say it's a level dividend stream, so G is equal to 0. And so they're saying, okay, what is that R? So it's kind of a tricky way of asking you, to back that out. But we've calculated the price by saying the dividend divided by R. And so it's the same way, only we're switching price and dividend. Okay, questions 6 and 7. They're both these constant growth rates. If you notice, it's the dividend divided by R minus G. Just notice there is some growth rate, so you just need to account for that. But otherwise, we're just saying, what is that, dividend worth in today's dollars? And that's what the stock price is, right? The value of the company is the present value of the future cash flows. This is just one of those basics behind valuation of a firm. And so that's why, as a firm manager, your job is to maximize the present value of those cash flows, because you're literally driving value for your owners of the company. Okay, and here's the same type of question, right? But instead of saying, hey, here's our dividend, the growth of the company itself, right? So if you know the earnings, dividends per share, all that's going on at 2%, but that year 4 it stops, right? And then starting in year 5, it's like, I'm not growing anymore, right? It's just going to be I'm paying out everything in dividends, right? I'm not growing the company. I'm just giving your money back to you. So this is a very mature firm. There's no new markets to tap, right? Everybody in the world uses our product. So I'm just paying nice, steady returns to the owners. So just given all of that, what should the stock price be? And so at the very end, there at the bottom, you see the equation itself, the growth rates. You notice it, initially we're growing at 2%. We're going to do that for 3 years, and then we're going to grow at 0%, right? Yeah. And then right here for question number 9, we have some oil fields, right? That produces 1.9 million barrels, but production is declining. This normally happens with any sort of mineral extraction. The cost of production transportation, right, is $26.50 a barrel, right? So that's my cost, right? But my price is $66.50 a barrel in 2018, right? I've got 8.5 million shares outstanding. My cost of capital is 9%, right? All of my net income I pay out, right? So I'm not growing anything. I'm just riding out this well. As long as it's, producing oil and I'm selling it above the cost to produce, I'm just going to do it until I run out of oil, right? And we're just going to assume those costs are constant, and everything. So assume that the oil prices are expected to fall to 61.50 because 66, right? $5 is going to drop, and then another $5, and then another $5, right? And then after that, it starts declining at 5% a year, right? And then what is the ending value of a share of my stock, right? And here's the math. I didn't want to throw it all at you right at the very beginning. But if you notice, there's 2018, 2019, and you notice that the production itself is going down, right? Because remember, the volume is what's decreasing. We also have the price of oil is decreasing at $5 a year. But my costs are remaining constant, but you notice my revenue, is declining. The expenses are declining, even though it's constant cost. And that's because my volume's decreasing. Right. And so because of that, I have my net income, revenue minus expenses, and I pay it all out in dividends. Right. And so if you notice there, when you start looking at going forward, or, you have all the calculate the present value of all these, and then you can get what the price per share is. That's that 56.61 there at the end. Right. And so given what our earnings per share, the net income, and the number of shares, right, then you're able to calculate the earnings per share of $9.18. And so the earnings per share per the price of the stock, right, is 16.21%. It's higher than cost of capital, but that's because my production is declining, right? So it's because I'm basically unwinding this position. At some point we will run out, right? We're treating this as if it's got this infinite life, but we know that it's not. Like we're basically taking the company apart. We're just doing it in a very sustained manner, right? And so our earnings per share to price is greater than cost of capital. So because we're not maintaining this in perpetuity, we're slowly unwinding it and paying the owners back their money. Okay, and then this one you're looking at a portfolio, right, that you're managing, right? It's $109 million total, and then the dividend yield on that is 5.9%, and then you get this particular management fee annually, calculated at the end of the year, right? And so the first thing that we do is say, okay, well, how much money is, this annual fee, right, is 0.59%. And then you multiply that by portfolio value. That tells you what your payment is this year. And then we can divide that by R minus G to get what the present value of a stream of perpetual cash flows is. Right. And then if instead of just going with a dividend, right? But if I'm growing by investing that in stocks instead of that that dividend yield portfolio, so I'm getting my yield is 4.9 instead of 5.9, right? By doing that, what it lets me do is I discount it at a lower rate, so it ends up being worth more, right? The lower your discount rate, the higher your value. So I hope that cleared up any questions around the homework. Module 1 and 2 makes up the first exam. So if you do have any questions, please let me know. I would love to answer any questions that you have. Thank you.